bear markets, bull markets, hedging, blue chip companies, trading and broking. To most, the stock market is mysterious. We've all heard of the terms, but what do they really mean? The stock market is a term that conjures up a bevy of emotions. It can be associated with risk, excitement, wealth, ticker boards and trading rooms. For most of us, the thought of living the life you want to, whilst the market simply grows your money, is a pipe dream, and quite frankly, an unrealistic one. Well, I'm here to tell you that if this is what you think, you'd be wrong. My name is Marcus de Maria, and I've been investing and trading the markets for over 17 years now. And for about the last decade or so, I've been training thousands of others to do it too. In this three-part series, I will be taking you on a journey in which we peel back the covers on an overly mystified industry. I'll be giving you tips and strategies, meaning that by the end of the series, if you've paid attention and are willing to take action, you will have the tools you need to start trading too. Last time, in the first of this three-part series, I went into detail about what the stock market really is, and I also spent the good part of the day riding up and down in a lift to demonstrate the difference between investing and trading. However, more excitingly, I also showed you how you can shift stock market odds in your favor and explain the closest thing to magic, the compounding effect. But as you will know, shifting the odds in your favor and being able to harness the mystical powers of compounding will not mean a lot unless you have a strategy that will enable you to actually trade. In this episode, I'm going to address this issue and give you several well-tried and tested strategies that I use myself. The strategies that I'm going to be showing you can be split into two categories. Two of the strategies can be classed as investment strategies and three as more trading strategies. The names of them are PCA, VCA, Buy Zone, Sell Zone, Buffalo and Leveraged Buffalo. So why, after showing that trading can be a lot more lucrative than investing, would I even bother showing you investment opportunities? Well, the answer is twofold. In terms of effort and time required to potential return achieved, the investment strategies I'm going to show you are high rewarding, taking little to no time, but with the potential to return far better than bank interest. The second reason for looking at these investment strategies is to explain some basic principles of the stock market that we can then apply to the trading strategies later in the program. But remember, everything from this point forward has risk, and what I'm going to show you are methods that other people have implemented to invest and trade on the stock market. This is by no means advice. You've worked hard for your money, right? Well, the idea behind investing is to make your money work hard for you in return. The principle is to invest your money, get some gains, and then to reinvest those gains immediately so that your money is always working harder each time. The result of reinvesting your profits like this is called compounding, and this is what we looked at last episode. And you'll remember how powerful it is. The first investment strategy I'm going to show you is called PCA, or pound or price cost averaging. Remember, the idea here is for your money to work hard for you rather than the other way around, and this is definitely the case for price cost averaging. The price cost averaging strategy takes a small amount of time to set up and then is completely automated. This particular strategy is how many people invest indirectly into the stock market via their pensions, for example. Imagine this scenario. Every month, normally on the same day of the month, money from your monthly income is transferred to your pension. The pension manager then invests some of that money by buying stocks. They are not timing the market, i.e. trying to get in at a low point or price. They're just buying at the current market price, irrespective of whether it has risen or fallen. They don't have to think about it. Once a month, they just buy. I'm at the bottom of this hill, and I am going to walk all the way to the top of this hill. Only to make it a little bit more interesting, I'm going to do it blindfolded. Okay. Whew. So, I'm here at the top of the hill, but as you can see, although I started at the bottom of the hill, I wasn't always going uphill. There were times when I actually went downhill before I went back up. So just like these hills, even when a stock is going generally in an upward direction, it does undulate up and down along the way. Because of this, on my route to the top, there were times that I was lower than I was previously. And because I was blindfolded, there was no way I was going to know if I was going to be higher or lower at any one point in time. And this is the same with stocks. Even with a stock that you're almost certain will go up over a long period of time, there will be market factors that mean it will rise and fall along the way. With this PCA strategy, you're buying into the stock at an average cost over time, not at a given high or low, so no thinking is necessary. But I'm sure you're thinking, why wouldn't I just invest all my money at the start? Take a look at the chart. This is a typical stock, and like our hill, is always moving up and down. You will notice in May, June and July, the price was high at around 31.25. What if you had some money during those months and without looking at the chart, you invested a chunk of your money? Well, sadly, you would have bought when the stock price was high. Clearly not a great idea. We really don't want to do that. Instead of buying once and risk buying at the wrong time, we invest the same amount of money every month. As you can see in the chart, some months you would have bought low, some months high, and some months in the middle. By buying monthly, you get an average of all of these prices. Since you're investing the same amount of money, for example £100 per month, you get more shares when the price is low and fewer shares when the price is high. Price cost averaging is widely used because it takes no thought at all and can be fully automated, simple and easy. At this point, I would like to introduce a concept that I recommend to keep in mind when making any decision, particularly in the stock market. Generally speaking, low risk means potential low reward. High risk means potential high reward. And this principle can be applied in the PCA strategy. This strategy takes the absolute least amount of effort. You can set up a direct debit and shares are purchased every month at market rate. With the right broker, this strategy can be set up in advance and fully automated. You might even be thinking, is it really necessary to pay a fund manager to do that for you? And you would be right in asking that question. So there you have it. Your first very simple strategy to get you started. So now, let's move from price cost average to value cost average. Value cost averaging, or VCA, is a way of attempting to lower the average cost over time by purchasing a little more in the months when the price is down and less when the monthly price is up. So how does it work exactly? Well, remember with PCA, we use the example of buying £100 worth of shares every month, no matter what the price. With VCA, we do it differently. With VCA, we're going to spend more when the price is lower and less when the price is higher. What we need to do is to look to buy less in the month where the price has gone up from the month before, and look to buy more if the price has gone down from the month before. For example, we're going to buy £75 worth of shares on the months that are up, and in the months it is lower, we buy £125 worth. Over the 2 months, you have still put in £200, like in our PCA example, but you've invested more in the months when the price is lower. What does this mean for the end of the year? Can you guess? Well, your average price comes down substantially because you're putting more money in when the price is at a better value, hence the name value cost averaging. It massively outperforms PCA over time because with VCA you have brought down your average price. Whereas PCA was fully automated, this strategy does take more time. In fact, it could take a whole 20 minutes a month. Can you handle that? With VCA, we're aiming to outperform the market, and you can wrap it up in your individual savings account, your ISA, so it is 100% tax-free. You can also do this within your self-invested personal pension, your SIP, so it is tax-free for a number of years. It's no secret that not paying tax on your profits massively boosts your profits over time. By watching this first part of the episode, I hope you've learned that with just a few minutes of your time every month, you can invest in the stock market, and with these strategies, you can minimize your risk of buying at a poor time in the market, which is most people's biggest fear. In the next part of the program, we're going to look at a few very interesting strategies where you can make money going down as well as up. Welcome back to Stock Market Secrets. Before the break, we explored PCA and VCA, two simple investment strategies that you could implement today to get you active on the stock market. With the pound cost and value cost average strategy, we've not been timing the market, but ensuring that we have time in the market. This ensures that we never miss any of the big moves that can make such a difference to your portfolios. In this part of the program, we're going to be looking at 3 different trading strategies to get you started as a stock trader. These strategies are Buffalo, Leverage Buffalo, but first we're going to be looking at Buy Zone, Sell Zone. Buy Zone, Sell Zone is an attempt to start timing the market without the stress of actual day-to-day trading. You can look at it once a week or once a month. You decide. It's simple. Once the stock price drops into a buy zone, it is time to start buying. And then when it goes up to a higher zone, it is time to start selling. The zones take all the guesswork out of timing the market. It is brilliant in its simplicity. Let me explain. Let's imagine that I'm standing in a chart right now. You simply draw a line at the top and bottom of the price range. This lower line is called the support line or floor. We then draw a line at the top of the stock price range, and this line is called the resistance line or ceiling. Then you also add another line in the middle of these 2 lines to split the stock price line in half, and then you split these segments in half again. What you're left with is a stock line graph that is split into quarter sections, or as we will now refer to as the 4 zones. Let's think about what we're doing for a moment. With price cost averaging, PCA, and even value cost averaging, VCA, we were quite happy to put money into every one of those zones, even in the top zone. The reason we did this was because we were not trying to time the market in any way, recognizing that timing the market is easier said than done. However, some of you might have been asking yourselves, why oh why would you want to buy when the price is in the top half, especially when the stock is in the top quarter? The answer is, you wouldn't. This is where the buy-sell zone concept comes in. As you can see from the diagram above, you have the lower half, which is your buying zones, and you have the top half, which are your selling zones. The principles behind this strategy is that you want to buy in zone 1, and when the price goes up to zone 4, you want to sell. In zone 2, you should think about buying, but perhaps less than in zone 1. And in zone 3, you should think about selling a percentage of the amount that you own. By looking at stock charts, which are available on the internet or even on your iPhone, you're able to set the time span to 1 year. Now, there are more advanced versions of this strategy which allow you to get in at a certain price, not just because a certain amount of time has passed. You've heard of a bull market, right? But do you know why it is called a bull market? Let's have a look at this footage of a bull. Let's see if you can see how it attacks. Okay, so now bear market. Let's look at this footage of a bear and see how that attacks. You'll notice something. A bull attacks upwards and a bear attacks downwards. And that's exactly where the two markets got their names. A bull market is an upward trending market and a bear market is a downward trending market. Interesting, right? So here we are in a wildlife park in Kent with these absolutely amazing European bisons, or as most people call them, the buffalo. Well, my favorite strategy is the one I've developed over my last 17 years of trading, and I named it the buffalo strategy. Now, in our last strategy, the buy-sell zone, we bought and sold stocks as the price moved from one zone to the next. In other words, we started to time the market. Now, the buffalo strategy means that we're going to start looking at timing the market fully. And why buffalo strategy? Well, that's our name for sideways moving markets, literally the buffalo roaming in the open plains of America. With the buffalo strategy at the most basic level, we're looking to identify stocks that are moving sideways in a channel pattern. And firstly, let's look at the word pattern. That's weird. Well, that's really strange. You don't often see that twice in a row. Okay, that is now really strange. That happened 3 times in a row. So that means that's a pattern. So now I'm ready for the next time. Excuse me, you're just about to fall. Now you'll notice something there. Those weird series of events had to happen 3 times before I realized there was a pattern happening. And this is the same case with spotting a pattern in a stock. If it doesn't happen 3 times, you do not have a pattern. If it happens 3 times, it's likely you have a pattern. And you can ready yourself to trade. And what pattern are we looking for? Here is an example of a stock showing buffalo formation, just moving sideways, just waiting for us to trade it time and time again as it touches the support line and resistance lines. Like in our lift analogy from the last episode, where we were able to make more money by stopping on every floor. With the buffaloes, we're buying and selling, and therefore we can maximize the potential gains. You'll notice that we're nearing the end of the program now, and you will be wondering how I'm going to explain a whole new strategy to you. Well, that's because it's not a whole new strategy. Leverage buffalo is exactly what it says on the tin. The strategy is exactly the same buffalo, however, it is with one major difference. In leverage buffalo, you will be trading someone else's money. But how? When we're talking about buying and selling stocks, luckily we don't have to go outside and actually buy something. All we have to do is hit the buy button. But what happens when we hit this button is that it instructs your broker to make that purchase happen. Now, the brokers I suggest you use don't make money on your success or your loss, but they do only make money every time you make a trade. And so they want you to be making as many trades as possible, and you can't always do that if you're fully invested and so don't have any more money for a new stock. In Leverage Buffalo, brokers will actually lend you money to keep you trading. Exciting news! But before you rush off to ask a broker for money, this is only recommended for professional traders. As I said, brokers make all the magic happen in the background. But one really cool piece of magic I'm going to show you in the next program is called shorting. With shorting, you can go one step further than trading stocks with other people's money. You can actually sell a stock you never even bought. And you'll find out how that works next episode. This series comes with a warning that past performance is not an indication of future results, and investing carries a large degree of risk. You could make money, but you could also lose it. But what I will say is that there are lots of opportunities out there. You just have to take them. And the only real bit of advice I'm going to give you is that there are a lot of different groups and a lot of different people that you can get involved with. Follow them and learn from them. Get tuned into this information and benefit from the knowledge.